What is all this easy money, lower, lax lending standards? This is all going to be more inflation, going to lead to more quantitative easing, money printing, a weaker dollar, right? All of this is bullish for gold and silver. That's why the prices are going up, right? And that's why they're going to keep going up. And in the meantime, the markets have not reacted. They're still shell-shocked from that correction.
Peter Schiff lays out a blunt reality that the markets are still refusing to process. He explains that the wave of easy money, falling lending standards, and renewed appetite for credit isn't a sign of strength. It's a signal of the inflationary cycle restarting. More borrowing means more money creation, more pressure on the dollar, and ultimately more fuel for quantitative easing disguised as support. According to this view, the dollar weakens while tangible assets like gold and silver gain momentum. And despite the recent correction, the broader market remains in shock, not yet pricing in what's coming next. As liquidity rises and purchasing power falls, precious metals continue positioning for the next leg higher. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
There wasn't a lot of exuberism there. But it was tempered, and there was a lot of people that were worried about a bigger correction, a lot of people talking about taking profits. And what I was saying was the mistake that people are going to make in this bull market is taking profits too soon. Now, sure, traders, you could have sold and bought back these gold stocks. They did have a big enough pullback. In fact, you could still buy back if you got out right at the top. But most people aren't going to get back in. They're going to get out and, they'll be waiting for a bigger correction. The corrections are generally very swift. Maybe they're shallow and they're over with. A lot of people who probably bailed out aren't back in yet. And the next thing they know, we're going to be at record highs. Now, certainly in the metals themselves, silver can easily hit a new record high this week. Gold, is a little bit further from its high. Gold still has a couple of $100 to go because gold, I think, almost hit 5,400. So we need a bigger rally in gold than we do in silver. But they're both likely to make new highs. And I'm going to get into some of the fundamentals because there were a lot of very bullish news items that we were getting in the market. Of course, one of them, I think, is the end of the government shutdown. I mentioned that on the last podcast that it looked like it was getting likely that the shutdown would end. And by Monday morning, it was pretty much a done deal. And that was really the catalyst for the $100 rise in the price of gold. $100 plus was the end of the government shutdown. Now, a lot of people might have thought intuitively, well, wouldn't that be bad for gold? Wasn't gold going up because the government shutdown was bad for the economy? It was creating uncertainty, and that was benefiting gold. And so that once that uncertainty was behind us, once the government reopened and that was good for the economy, that would hurt gold. That's what a lot of people might have thought. But the opposite happened because the government reopening isn't bad for gold. It's the government staying open that's bad for gold. Because when the government is open, it's doing bad stuff. It's spending a lot of money. It's borrowing a lot of money. It's printing a lot of money. The problem with the shutdown was we didn't shut down enough government. Maybe if we shut down a lot more government, that might have been bad for gold. But the fact of the matter is it's business as usual in Washington, D.C., and that's good for gold because it means the reckless spending is going to continue. The money printing is going to continue. And so inflation is going to get worse. The dollar is ultimately going to crack. And all of this is bullish for gold and bullish for silver.
Peter Schiff explains that one of the biggest mistakes investors make in a real bull market is taking profits too early. Recent pullbacks in gold and silver created nervousness, but Schiff notes that these corrections were brief and shallow. Quick shakeouts that left many traders on the sidelines while prices continued climbing. Silver is now poised to challenge new record highs, and gold isn't far behind, needing only a few $100s to break its previous peak. Schiff points out that the true catalyst for gold's surge was the end of the government shutdown. Instead of easing pressure, it signaled a full return to overspending, heavy borrowing, and continuous money creation. In other words, Washington's business as usual is massively bullish for precious metals and deeply bearish for the dollar. Let's get into the interview.
The bigger risk is that this blows a bigger hole in the balance sheets of all of the lenders. So much so that they may need bailouts from this alone. You may have to have a Federal Reserve bailout of lenders. Now, of course, if all these mortgages are guaranteed by Fannie and Freddie, that also hurts the value of Fannie and Freddie, because Fannie and Freddie has to guarantee these mortgages for the next 30 years. And even worse, of course, separately, if they have 50-year mortgages, and those are portable and assumable over a 50-year time horizon. But forgetting about the 50-year mortgages, all those 30-year mortgages that have 25 years left on them or whatever, that Fannie and Freddie guarantees right now, all of those mortgages will become significantly more risky if they're assumable and portable. That means that Fannie and Freddie are on the hook for much greater potential losses on these mortgages, which means the U.S. taxpayer, of course, is on the hook right now with the guarantee. But all these things that they're doing, they're trying to loosen the reins. They're trying to make it easier for people to borrow money, to overpay for homes, lower their monthly mortgage payments, get rid of the FICO scores. All of this is designed to keep air from coming out of the housing bubble. And so I know that they obviously are getting desperate, coming up with all these gimmicks, but I don't know how many of them they're actually going to implement. But in the meantime, just talking about all this stuff should be very nervous. I don't know why the banks, those stocks aren't really going down. The financials are doing all right now. Fannie and Freddie have gone down. Tech stocks are going down. Crypto is going down. But this is all dangerous stuff for the financial sector. But all this is great for gold and silver, because what is all this easy money, lower, lax lending standards? This is all going to be more inflation. It's going to lead to more quantitative easing, money printing, a weaker dollar, right? All of this is bullish for gold and silver. That's why the prices are going up, right? And that's why they're going to keep going up. And in the meantime, the markets have not reacted. They're still shell-shocked from that correction. And they haven't realized, like I just said, silver was only higher than it is right now on one day, and it was barely higher. Yet you have all these stocks that are in bear markets because of that, right? So it's not going to be long. All those silver stocks, I think, are going to make new highs. Gold stocks, some of them have made new highs. Barrick Gold made a new high. Their earnings came out on Monday. Again, blowout earnings, record revenue, raised the dividend. The stock's up about maybe 13% in the last 3 days. And it's at a new high, so it took out its high. I noticed IM Gold, another stock we have even in our value fund. That stock hit a new record high today, or I don't know if it's a record going back, but 52-week high. So some of these stocks have taken out their highs, but the vast majority of stocks are still significantly below where they were when gold and silver prices were not that much higher than they are right now. But it's just that fear entered the market, and it's just taking a little bit of time for that to, go away. People have a memory of that. But again, that's what the markets are doing. They're trying to check the enthusiasm. They're trying to prevent people from getting too long, too leveraged by introducing some two-way risk in the market, right? It's not going to go up every day, but you got to be smart enough to recognize that this is a massive bull market. This is early, and any downturn is simply an opportunity to add to your positions. That's it. And yeah, you don't need to lever up. If you're going to lever up at all, you got to wait for the flush out. You got to wait for the big drop if you're going to do something on margin, right? Don't chase the market like that. But yeah, if you get a big pullback, you could take advantage of the fact that other people are getting chased out of this market.
As Peter Schiff warns, the deeper risk now isn't the headlines. It's the structural damage quietly building beneath the financial system. When policymakers chase housing stability with looser lending, portable mortgages, and artificially cheap credit, The burden shifts from lenders to taxpayers and from banks to the currency itself. That's why the financial sector is wobbling while the precious metal space continues to strengthen. We're watching the early stage of capital fleeing paper promises and moving toward tangible assets. Gold and silver are signaling what the broader market refuses to acknowledge. The path forward is more inflation, more intervention, and more volatility. In that landscape, every pullback becomes an opportunity for disciplined investors, not a reason to panic. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.